right. Welcome to A Better Way podcast. I'm McKay Shoell, your host. Today we've got joining the show, Clay Collins. We're excited to have you here today with us, Clay.
Glad to be here. Thanks, McKay.
Well, I want to play a little get to know Clay Collins. Can you tell me a little bit about yourself, Clay?
Yeah, I guess the thumbnail sketch is I'm originally from Northern California, and I only point that out because Canopy is headquartered in Utah. Eventually, I ended up at the University of Utah and graduated in accounting. Ended up at the big four accounting firms for about 5 years, Deloitte & Touche and Ernst & Young. After that, I joined on with Rio Tinto, which is a global mining company. I was with them for 15 years in finance type roles. One of my latest roles with them was I was a CFO of a copper and gold mine in Australia. And then things happen as they do, and I joined up with Canopy in 2019. So I've been here a little over 4 years.
Awesome. So when not being a super rad CFO, Clay, what do you like to do in your free time? What do you like to do for fun?
Yeah, well, the first part of my life would have been, at least married life, you know, soccer games, coached some football for my son, got him all the way up through the youth and through. I didn't coach him in high school, but definitely was one of the major fans. So we have a lot of fun doing that. Do a little bit of skiing, a little bit of dirt bike riding, but other than that, that's probably about the extent of it. I do also like to do some writing. Haven't really published anything, but it's kind of a creative outlet.
That's awesome. What kind of writing, Clay?
Yeah. I would say classic fantasy quest type novels, kind of in the Lord of the Rings genre, something like that.
Very cool. The things you learn in a podcast that you never know after working with someone for 4 years. I love it.
There you go. Yeah, don't tell anybody that.
So Clay, thanks by the way, and I won't hold against you that I know you went to the University of Utah and you're a Utah fan, but that's okay. We still love you here at Canopy.
Thank you. I'm glad to be here.
Thank you. So tell me a little bit give me a day in the life of a CFO. I'm curious, what does a CFO do?
Yeah, recently I submitted my resume to one of the investors that we had, and included all the history. And my most recent piece, I had put down there, all things financial. They actually returned that to me and said, "Yeah, that's not sufficient." So anyway, I can't give you that answer anymore. Now, it's kind of a grab bag of things, and not necessarily in order of priority, but the things that come to the top of my mind are, our warehouse banks relationships. We have 5 warehouse banks, partnerships, we would call them here at Canopy Mortgage. And definitely, there's a partnership, a friendship, a camaraderie really with the warehouse banks, because obviously they're very important to what we do. Their capital we utilize and be able to do what we do. So we do look to them as partners, not just a bank relationship. So that takes a little bit of time. But, we have to renew it annually. And as the market becomes more of a challenge, there's more questions. And we just got done wrapping up our 2023 renewal season, and which is very positive, because I hear that some IMBs aren't as successful. I'm sure many are, but we are one of the successful ones in renewing those relationships. It also entails insurance. We have a general liability insurance and our surety or fidelity bond for being a mortgage banker, and then some other various ones like directors and officers and those types of things. And that relates to the next significant item, I would say, is risk management. We do have a formal risk management process. We renew it every so often or periodically, but it's more than just that exercise. It's every time I'm in a conversation, I need to be thinking about risk to the company. I'm not the only one, but it is a hat that I wear just to make sure, what are we doing to mitigate our risks? Is this something we want to get into? and have those, just those types of thoughts to make sure we're doing the right thing. How are our financial relationships set up? What can we do again to reduce the risk to the company? So it's important. And, it also helps. The more we have those types of conversations, it becomes more of a culture aspect within the company, and it puts us on a more solid ground, I would argue. There's financial analysis. Right now, our team isn't large enough to have a bunch of independent analysts out there working, cranking, doing the numbers, and that's okay. We'll get there. But for now, until then, that primarily resides with me. And I actually enjoy it. There's probably an argument that you shouldn't have your CFO doing that much. There might be some higher value things someone may argue, but it's real interesting and kind of scratches that itch, so to speak, of solving problems. And I don't know. I just find it rewarding when I get to do
What?
it.
And I think that's something unique about you, Clay, that I've noticed. Oftentimes when you hear words like chief financial officer, you think, oh, they're above getting their hands dirty. And I think that's something very unique about you. I've found you're okay to get down in the weeds and grab a shovel and be there right alongside your team. And I think it only makes your team more powerful doing that. So.
Yeah. Well, thank you. I mean, there are opportunities to do that. I enjoy doing it. I do try to manage my time and try to bring others on board where we can. But yeah, no, thanks for that. It's this size of an organization, we're growing and we have a lot of potential. And as we transition into something bigger and better at some point in the future, that's what we all do. You see it all the way with Aaron, our CEO, on down through the ranks. It's really an all hands on deck, do what we got to do type of a mentality. And, that's what you would expect for this type of an organization. It's got a lot of strong growth potential.
Love it. So one of the things that I just wanted to highlight that you talked about was risk mitigation. What do you mean? Like what types of risks are there for an independent mortgage banker, IMB, that you referenced earlier? Like what risks are you kind of watching out for?
Yeah, let's see. So, just it's a grab bag. It's anything that applies. One instance that comes to mind would be, we have large bank accounts. This is finance related, but it is something to think about. Is you start to look about depository coverage limitations. If we have too much money in one bank account, then it might be exposed to any risk if there was a bank failure or something to that effect. I mean, and it's not out of the realm, right? We saw Silicon Valley Bank. These things do happen. So there are different types of accounts that you can get into, spread that risk over several overnight accounts. And that's one thing that keeps that there. Others would be challenging. What's the model that we're using, or who are the partners that we're bringing on? How comfortable are we with their history? Is it a broker or whatever? What do they have? And we look at their financials, and there's a team. That's not all up to me, but that's what we're all doing. We're trying to vet these individuals to make sure that they don't bring in an increased amount of risk that's above or beyond what's acceptable to us.
Perfect. Thanks for expanding on it. So switching gears a little bit, wanted to talk a little bit about Canopy. And for some of our listeners, they're intimately aware of the model that we have, where oftentimes we allow branch managers to maintain their P&L. And if you could kind of expand on what does that look like? What does it mean, a quote P&L model?
Yeah.
From a CFO's perspective.
Sure. I mean, it's the best of both worlds, if you will. I mean, if you want to be in that model where you can manage your business as if you're the owner, you are the owner. You leverage Canopy for what we are to provide that support. But other than that, you own it, and you can make the decisions to, accelerate growth and to manage costs. And the greatest, but key to that is understanding what you're looking at. And admittedly, I would say there are many that understand their P&Ls, come in, they have got a strong history with it, and are very comfortable. Some aren't, and if you aren't, it's okay. But the warning there is we need to get up to speed with it and leverage the people we have here at Canopy or anyone else you need to understand what that P&L is communicating. And if you step back, maybe exhale, if you're uncomfortable with it at first, you just need to, there's three main pieces you want to understand, and this is true to any P&L that you would come across. You have your revenue piece. You need to be comfortable with how that revenue is coming through, what generated that revenue, how does that work. Um, uh, then you need to look at your cost of sales. Those are your variable costs. Those are the costs you incur when you're trying to, you know, sell a loan, or so it includes ones you successfully sold. For instance, a credit report. You run a credit report, you close the loan, that's great. That was cost for that loan. You might run a credit report for a loan that doesn't go through. It's still a cost. So these are costs that are going to accumulate based on activity, sales activity, if you want to simplify it. And then you have your general administrative. Those are your fixed costs. They're going to be there whether you sell one loan or you sell 100. And in times like this type of a market, it's really key to understand what those fixed costs are and what is the value that you're getting out of those costs. Can you do it for less? Can you do it? Like salaries and wages are down there in your general administrative. Do I need 3 processors now that we're not doing the volume we used to do? Maybe I can do it for 1, but you need to be mindful of those types of things. And then I would say for all of those 3 together, something that's really key to understand is what's your break-even point. I know we don't talk about break-even points probably for the last 15 years, but here we are. Now's a great time to understand what that is. And it's really it's how much revenue am I netting off of those top 2 pieces, your revenue less your variable costs. So whatever your revenue is that's left over, um, whatever that unit cost, you divide that by the number of units that you produced, and that'll come up with a net revenue per unit, and you divide that into your total fixed costs. And so that means that incremental piece of revenue that you get, how many units do you need to generate in order just to cover your fixed costs that are going to be there regardless? So once you figure that out, for instance, if you did 10 loans and you have $10,000 of production, and your net revenue is 1,000, or your gross profit's another term for it. So 1,000 into 10,000, you need 10 sales, 10 units sold for that month in order to at least cover your fixed costs. So that's a real key thing to understand and appreciate. And I think when people can digest that and appreciate what that is, it helps you make decisions on the type of model that you're going to run. What's your cost structure going to look like? Do we need to add this? Do we need to add that? Should we be taking something out of the mix? So it's a key piece, and hopefully the days will come when people aren't as worried about it again. But right now, it's a good time to know what it is.
Definitely. And I like one of the things you said is, sometimes you got to make hard decisions and cut support staff in leaner times. And then other times you go on a hiring spree. And unfortunately in this season right now, it seems like it's more the try and do everything you can to keep it lean and mean, right?
That is for sure. I mean, I have a history in the mining industry, and similar. I mean, that's a commodity space. There's a lot of similarities in the mortgage industry with interest rates. There's, pricing takes place outside of our influence, and so we have to live with what the market gives us. And just as in mining, it's same here in the mortgage industry. In a trough, in a downturn in the cycle, those people that can manage their costs most successfully are the ones that come out victor in the end. You make it through the trough, and then you're the one of the few standing, and you enjoy all the benefits as we come back out of that trough.
I love it, which also ultimately leads to more market share, right? If you can survive the lean. Okay, Clay, one other question for you. If you had advice for an LO that is currently running a P&L, just one good solid piece of advice, it could be a couple pieces of advice if you can't limit it to one, what would that be in this challenging market?
now more than ever, you need to own the P&L, and it can't be something that is in the background. It needs to be in front and present more frequently. I don't know if that's every day, but it's got to be at least once a week. Got to understand what's coming in, what's going out. It's there to help. It's, you can actually even kind of project where things are going as you get more and more comfortable with what that P&L is telling you based on historical performance. So if you understand that, you get comfortable with it. And if you need to have a discussion with someone to help you get comfortable with it, have that discussion, because that is, I wouldn't say it's a crystal ball, but it's pretty good at giving indications of how things are going, where they're going, and what you can do to influence your future.
I think that's a solid piece of advice. It goes back to something I observed really early on with Jeff and Aaron. I had the unique perspective of working with them when they started their own mortgage brokerage. And one of the things I noticed is this was their business. And if that meant getting a second mortgage in order to make payroll, they did that. And I think if more people treated the P&L like, hey, this is my business, it would make for a much healthier balance sheet for all mortgage companies at the end of the day.
Yeah, no doubt. I mean, the days of, just pump in loans and everything else will take care of itself, those days aren't with us right now. And so just being more diligent and deliberate in what we do on the cost side will pay dividends for sure.
So last question is, what would you say the forecast is for the mortgage industry? Just from your perspective, you have a unique one in that you interact with warehouse banks. You kind of have the ability to peek behind the curtain, whereas a lot of originators don't. So would love your perspective as to a little bit of a forecast where we're headed.
Yeah. I mean, I'm not going to say anything that's probably isn't heard or read somewhere else, but I do have those conversations with warehouse banks. I also read the financial press and talk to brilliant people such as yourself. So it's a funny situation we're in right now. You go to Home Depot, and the aisles are packed, and you think, wow, this is great. The economy is looking pretty good here. But in the end, when you raise interest rates, that will have a braking effect on the economy. Even though we seem to be a little bit resistant to it as a country right now, that's still going to start to bite to some degree going forward. That coupled with high interest rate environment that we have, low inventory for housing, I'm afraid Q4 is going to decline from where we're at right now to a level that's uncomfortable, and then 2024 probably will be pretty much whatever we come out of Q4. I don't know about if it's going to be even or steady, but something close there too. I don't think it's going to become roaring back in 2024. So again, it highlights the fact that we really have to be managing costs if we're going to win this game over the near to midterm, because those don't look anything like we may have been or we have experienced, in the last 10, 15 years. So anyway, I wish I had a bit more positive report, but I think, there's more to come, and we just kind of got to hang in there. There's definitely loans are taking place. There are things happening. It's not like someone turned off the faucet and it's all gone. It's there. It's just being able to survive, being smart, intelligent with how we spend our money, staying alive, and then picking up what others have to leave behind because they weren't diligent managers of their industry or their product.
Spoken like a true CFO. I love it. So he is Clay Collins. He is the Chief Financial Officer for Canopy Mortgage. We're thankful to have him on the show today and get to know him a little better. So thanks for your time today, Clay. Have a great day.
Thanks, McKay. It's my pleasure. Take care.